What's going on, guys, and welcome back to my channel. Today I'm talking about a new portfolio slice that I have in Unicorn. It's called Value, and I gave it a 5% allocation. If I can go ahead and show you guys right now. So boom, there's Value. What is Value? So Value is basically a collection of beaten down high dividend stocks. I am the Statue of Liberty of investing. That's right. Give me your stocks that nobody wants. I will gladly take them. Obviously, with a portfolio like Unicorn, I have to take my investing very seriously. So, Value is not a whole bunch of junk stocks necessarily. They're just beaten down stocks at the moment. So, let's go ahead and do a deeper dive on Value. So over the past 5 years, value is down 3.68%. So that says a lot considering every single portfolio I have on M1 Finance is most likely up over the past 5 years, with maybe one other exception. There's about 10 holdings in value with a dividend yield of 4.9%, no expense ratio because there aren't any ETFs. And let's go ahead and take a look at the holdings. So front running value is Altria, and I finally had to give in. Altria is pretty much like everyone's favorite stock right now, especially the financial YouTubers, especially people in the investing community. I think a lot of things that PPC does tends to trickle down. And those of you that are part of the community a little bit more probably have heard of Altria before. They have been increasing their dividend yield for over 20 years. They are a sin stock, pretty controversial actually. They've been in the news a lot recently. I finally had to take the plunge. That doesn't mean this is my first rodeo with Altria, but this is actually my first time getting serious with Altria and actually welcoming it into its own pie, and it is actually leading the way in terms of target. And so because of that, you'll notice that the chart right here looks a lot similar to what Altria looks like over the past 5 years. But that's Altria, and I won't necessarily do a deep dive on each of these companies. I'll just go over them pretty briefly. But I will do a deeper dive on healthcare in general in the video later this week. So stay tuned for that. So jumping right into the rest of the stocks, the second largest holding is also a dividend aristocrat. It's Cardinal Health. Let's go ahead and take a look at Cardinal Health. So it's sporting virtually a 4% dividend yield. Like I mentioned, they have been increasing their dividend yield for over 25 consecutive years. And if we take a look at Cardinal Health from a long-term perspective, you can see that it's quite beaten down. So all-time high currently sits at around $92 per share. And so that represents a total decrease of about 47% where we're at right now. So that's pretty massive considering they're at $48 per share. If we take a look at the size of this retracement, that is one heck of a retracement. We are past the 0.618, zeroing in on the 0.786. I don't know if we'll actually get there, but that is quite deep. In contrast, let's actually take a look at Altria, because we talk about how much of a value Altria is, but what people don't talk about is how much it's gone up since the 2009 recession. So let's put this into perspective. Altria, from the bottom of the 2009 recession all the way to its all-time high, has a total increase of 428%. That is massive, and that's actually pretty unheard of in terms of pretty large cap stocks. For reference, that's 428%. For reference, let's take a look at a similar, I wouldn't say growth stock, but a blue chip stock that's actually done pretty well lately, like Procter & Gamble. Remember, Altria is at 428%. Procter & Gamble to its all-time high, it's only, and I say only, but it's 178%. So that's a pretty large difference, I would say. And Procter & Gamble is no slouch. Let's put this into perspective even further. Something like McDonald's, which also has been doing pretty well lately, except it hasn't taken quite the hit that Altria has. From the bottom of the 2009 recession all the way to the top, it's gone up 365%. So basically, in that time frame, Altria has increased more than McDonald's, and McDonald's engages in way more share buybacks than Altria does. So let's go ahead and take a look at Altria again. because if we take a look at the size of this retracement, we are not at the 0.618 yet. I mean, it's pretty deep, I'm not gonna lie. And we recently made a lower low relative to the low made here towards the start of 2019. So it isn't there doesn't necessarily have to be a bottom soon for me to get into it. And the retracement is pretty deep, but it could be a lot worse, is what I'm saying. So one of the highest flying stocks since the 2009 bottom is finally showing some retracement. So that's basically the way that I see it. Long-term perspective, I think we're fine. And in fact, look how much we've gone up above the 200-month moving average. So if we get back to this level, I think that'd be one heck of a buying opportunity. But I went ahead and got a head start on it. I'm not sure if I would continue to buy Altria should we dip below this level. I might just take my money elsewhere. That doesn't mean I'll sell. That just means that I might focus somewhere else. My method of investing is not just dividend investing, but it's a blend of both capital appreciation and dividend investing. So I try to be a little bit more strategic than just buy and hold and buy whatever's cheap. But anyway, so yeah, like I said, just still more room to fall, and it would still be considered healthy for Altria. So that's my spiel on them. And let's go ahead and look at the rest of the stocks. So Carnival Corporation is a travel company, and it makes up about 15% of my portfolio. It also sports about a 4% dividend yield, 3.96, but let's go ahead and round up to 4 just because. Everybody knows what Carnival Corporation is. They're basically a cruise company, and they're actually the largest global cruise company with more than 100 ships on the seas. They have several brands that they've acquired and also launched themselves. And this is actually one common theme that you'll find in a lot of my stocks is when I see this phrase, X company is the largest X industry company. And so that's exactly why I invest in companies like Home Depot, is because they are the largest home improvement company. That's exactly why I invest in companies like Caterpillar, because they are the largest farming equipment company. So Carnival is no exception. And let's go ahead and take a look and see how much of a dip they're actually in. So Carnival Corporation, if we take a look at from the 2009 bottom, their retracement is also pretty deep. They're not at the 0.618 quite yet, so it's actually a pretty similar retracement to Altria. But yeah, I definitely wanted to start to scale in a little bit early. All-time high currently sits at around $72 per share, which is currently about a 32% drop so far. So just because a lot of the stocks on my portfolio are dividend aristocrats, doesn't mean they all have to be dividend aristocrats. So I am going to take advantage of stocks of all different kinds, and Carnival was no exception. The next stock, however, I believe may be a dividend aristocrat. Actually, they are a dividend aristocrat, and I can confirm that. And this one is ExxonMobil. But like I said, I won't go through each of these individually. I'll just go ahead and read them off. ExxonMobil, I actually made another video on. I will link that in the description down below. The majority of the rest of these are all biotech or pharmaceutical companies, which I'll make a dedicated video on. There's also IBM, which is a technology company, and PPL Corporation. The other thing I want to talk about is also having to do with value, and that is this. I started to dedicate a lot more money to stocks that I would consider to be good bargains and that I want most of my money going to. And so that is going to basically involve 3M, Johnson & Johnson, and Caterpillar. These right now are my favorite stocks to invest in at the moment. And let's just, in particular, I like 3M and Johnson & Johnson the most, right now at least. And the reason for that is because they're just such large corporations that you're getting so much diversification when you invest in these companies. Both of them are actually operating in about 4 different subsectors within their larger sector. And so, yeah, like I said, even though they are somewhat of an industrial company, they are involved in consumer as well, and as well as healthcare and electronics and transportation, and basically the list goes on. But that's basically the 4 main segments. So like I said, instant diversification. If we take a look at 3M from a long-term perspective, Look at that. I mean, that is just one heck of a buying opportunity, like I said. And the one thing that really separates 3M, in my opinion, is that they are no slouch when it comes to actually increasing the dividend yield. $1.44 this year, $1.36 last year, $1.18 the year before, $1.11 the year before. So you don't really get both of those things all in one stock. And so 3M just feels like a perfect fit for my type of portfolio anyway. And it's hard to say when the actual bottom is going to be. And I don't want to make a crazy call just yet, but I would say that this kind of looks like bottoming action, especially because the last lower low was only slightly lower than this low. It feels like one last bit of capitulation. And the last three candlesticks have all been pretty strong. Still a little bit of hurdles to get over, but for the most part, I like 3M where it's at right now. And I have no problem with averaging down as much as I need to, pretty much. So, and that's why basically for the first time in Unicorn's existence, I am making some stocks 5% of this portfolio. And then Johnson & Johnson also pretty much needs no introduction, but I'm lower on this one than I am on 3M. I'm currently down 6.72%, but I continue to average down. And then Caterpillar is also pretty similar to 3M in that they are an industrial stock that has been beaten down. Really strong bounce off of the 200-month moving average. Not sure if this is going to be the bottom, but for the most part, like once again, no problem averaging down. So pretty much the way this works is I find companies that I don't really mind averaging down. Altria, I wouldn't say is in that bucket. Altria, I think there's a little bit more uncertainty than I like for my taste, and that's why I squeeze it into my value pie, which that value pie shouldn't be more than 5% of my portfolio at any time. There's a few reasons for my value pie actually, and that's basically I believe that if you buy stocks at cheap prices, and this is actually going against the Warren Buffett philosophy, Warren Buffett is kind of more towards the idea of buying wonderful companies at decent prices, and that's actually why Berkshire Hathaway was able to scale up so much. So this is a little bit of the opposite. This is buying good companies at great prices, and I have no problem with dedicating a small portion of my portfolio to that. And like I was saying, I think buying stocks with awesome PEs, great dividend yields, great dividend history, I think is a solid strategy. And even though it is a little bit riskier, especially because a lot of these stocks are healthcare, so there isn't all that much diversification in this value portfolio, I'm okay with it because I like these companies. And a lot of other mutual funds and ETFs like these companies too. You'll find most of these on the XLV, which is the healthcare ETF, and you'll find some of them in some very popular mutual funds as well. So it's not as if I'm picking these stocks out of the blue. There's a reason for that. And my main point was that if you buy stocks with great PEs, I think you will get rewarded over the long run. And so that's basically why I'm attacking these. The other thing is that I really like stock picking, and maybe I want to be a hedge fund manager at some point, but M1 Finance really gives me a chance to be creative, and it's basically my creative outlet to make my portfolios just the way I want them. I'm very thankful that this platform actually exists, and so I'm taking full advantage of all these little features. And it's possible, yeah, maybe that these companies that are actually value are going to go down even more, and that's totally fine. The risk is minimal, but I think the payout is actually pretty good considering a lot of these are 20%, 30%, 35%, 40% off of their all-time highs. So you give yourself a lot more cushion there when you start investing with such a deep discount. So that is going to wrap it up for Unicorn. I'm at around 17,000, so that basically puts value at around $784. Once again, that's about 5% of my entire portfolio. Yeah, thank you guys for watching, and I'll see you guys in the next video.